Imagine waking up, checking your phone, and seeing a notification. You've just been paid. You didn't drive to work, you didn't clock in, and you didn't sell anything. You just own something. That is the power of dividend investing. Today, we're going to decode exactly how you can build a reliable monthly income stream using the stock market. Here's our roadmap. We aren't just going to talk about what dividends are, we're going to cover strategy. We'll look at the difference between high yield and high growth, meet the aristocrats of the market, learn the snowball magic of drip, and most importantly, how to avoid the dangerous yield traps that lose people money. First, the basics. Think of a dividend like rent money. When you buy a house and rent it out, the tenant pays you cash flow. When you buy a share of a company, like Coca-Cola or McDonald's, you are a partial owner. If that company makes a profit, they can choose to share a slice of that profit with you. That payout is the dividend. It's a reward just for holding onto the stock. Now, you can't just buy the stock on the day they pay and expect a check. There are rules. The most important date on this timeline is the ex-dividend date. Think of this as the cutoff. You must own the stock before this date to get paid. If you buy it on or after this date, the previous owner gets the check, not you. Not all dividend stocks are created equal. You generally have two choices. Choice 1 is high yield. These are like established cash cows, utilities, or real estate. They pay you a lot of cash right now, but the stock price might not double anytime soon. Choice 2 is dividend growth. These are companies like Apple or Visa. They pay a smaller amount today, but they increase that payout every single year, and the stock price tends to grow faster. Neither is wrong. It just depends on if you want cash now or wealth later. Let's look at the math. Dividend yield is just the annual payout divided by the stock price. Here is the trick. Because price is the denominator, if a stock price crashes, the yield percentage shoots up. Remember this, a high yield isn't always a good thing. Sometimes it means the company is in trouble. We'll come back to that. If you want reliability, look for the aristocrats. These are companies in the S&P 500 that have increased their dividends for 25 years in a row. Through the dot-com bubble, the 2008 crash, and the recent pandemic, they didn't just pay, they gave their investors a raise. That is resilience. We can take it a step further. We have dividend kings, with 50+ years of increases. Then contenders and challengers. When you're building your portfolio, don't just chase the highest number. Chase the longest streak. Consistency is the secret ingredient to sleeping well at night. Here is the secret sauce to getting rich slowly. DRIP. It stands for Dividend Reinvestment Plan. Instead of taking the cash and buying a coffee, you tell your broker to automatically use that dividend to buy more shares of the same company. Why does DRIP matter? Look at this chart. The gray line is taking the cash. The blue line is reinvesting it. It's the snowball effect. Your dividends buy more shares, which pay more dividends, which buy even more shares. Over 20 years, the difference isn't just pennies. It can double your total return. How do we know if a dividend is safe? We check the payout ratio. This compares what a company earns versus what it pays out. If a company earns $1 and pays you 50 cents, that's a 50% ratio. Safe. If they earn $1 and pay you $1.20, that's over 100%. That means they are borrowing money or selling assets to pay you. That dividend is likely to be cut. Avoid those stocks. This brings us to yield traps. If you see a stock paying 12% when everyone else pays 4%, be suspicious. Usually the market has punished the stock price because the business is failing. Don't reach for yield only to lose your principal investment. Quick note on taxes. Uncle Sam wants his cut. Qualified dividends are taxed at lower capital gains rates. Ordinary dividends, like those from real estate investment trusts, REITs, are taxed like your regular paycheck. Pro tip: put those high-tax REITs in a tax-advantaged account, like an IRA, to shield your money. Finally, how do we get paid monthly? Most US companies pay quarterly, but they don't all pay in the same months. If you buy a Schedule A stock, pays Jan/APR/July/October, a Schedule B stock, and a Schedule C stock, congratulations. You now have checks hitting your account every single month of the year. Dividend investing isn't a get-rich-quick scheme. It's a get-rich-for-sure strategy. Focus on quality, check the payout ratio, turn on DRIP, and be patient. Thanks for watching, and happy investing. Make sure you hit like and subscribe the channel